Michael. Hello everyone and welcome to the first joint webinar between Climate and Energy Finance Group and the Otago Energy Research Centre here at Otago. My name's Sebastian, I'm the Deputy Director of CEFGroup, and today we have for you Karen Silks from Westpac. And I just want to give a short introduction, although I could probably talk for quite a while. So Karen was a graduate from Canterbury, I believe, and has started a job at Westpac and has worked her way up all the way to being the General Manager of the Experience Hub and Transformation, as well as a commercial, corporate and institutional banking. She's also the chairperson of the Sustainable Business Council and a co-chair on the Aotearoa Circle Sustainable Finance Forum, which is releasing its report in a couple of weeks, and we might get a few sneak peeks about what they've been looking at. She's also led Westpac to have a lending target of $2 billion towards climate change solutions by 2020. Led the issuance of the first green bond in New Zealand. And yeah, we'll hopefully shed some light on the Sustainable Finance Forum and, you know, what's happening in the space of sustainable finance and energy futures in New Zealand. Over to you, Karen. Thank you.
Thanks. I'll just start sharing. Where am I? Click on that. Okay, how's that looking? Sweet, okay. Well, kia ora, everyone. Thanks for joining me today for a discussion on sustainable finance and how it might support a new energy future in New Zealand. As Sebastian said, on the 3rd of November, the Sustainable Finance Forum, of which I am a co-chair alongside Matt Winneray, who is the CEO of the New Zealand Super Fund, will release its final report outlining a number of recommendations to support the development of a more sustainable financial system by 2030 here in New Zealand. We see that as being one that incorporates the value of social and environmental outcomes alongside economic. Today I'm going to share a little bit more on the background to the forum and provide you with an indication of the areas that our recommendations will focus on, and talk a little bit about some examples of where application may help in terms of the transition of our energy demand and supply sources here in New Zealand. I wanted to kick off just quickly though with a couple of comments on the impact of COVID. So COVID's been seen by many as a wake-up call, one that brings to life future risks we face from disruption as a consequence of environmental and social challenges, largely as a consequence of human behaviour. From an economic perspective, on a relative basis, our economy has held up pretty well, certainly stronger than we originally anticipated that it would be. But we do still hold some concern for future performance as and when some of the fiscal and monetary stimulus relief support dissipates and business and consumers really start to feel the brunt of its impact. Of course, some industries are already experiencing significant impact, and obviously tourism and hospitality are two that we would call out. The energy sector itself saw significant fall in demand under alert level 4, but has experienced a strong rebound with demand climbing back almost to pre-COVID levels as domestic conditions have improved. We do anticipate that fiscal and monetary stimulus that has supported the rebound to date will continue through 2021 and into 2022, really supporting the drive for improving domestic demand as a replacement of things like international tourism ahead of our borders reopening. If you look at that graph on the top left-hand corner there, our growth forecasts are premised on a progressive reopening of borders from about April of next year and progressively through into early 2023, depending on which geography we're talking about. But as we look forward from here, and I'm sure I'm preaching to the converted already here, but New Zealand really has an opportunity, and I would argue the requirement to transform our sources of energy use and supply to improve environmental outcomes and preserve some of the critical natural resources we have, for future generations. Today, New Zealand portrays itself as heavily weighted to renewable energy sources. However, when you look at the overall energy mix, and I've referred to Transpower information in terms of doing this, our energy mix is only 40% renewable, largely as a consequence of electricity comprising only 25% of total energy use today. So transport and process heat requirements comprise over 30% of New Zealand's total emissions today, and are still predominantly met through the use of coal, gas and oil. Transpower projections indicate by 2050 electricity could form up to 60% of our total energy use in New Zealand if we were to enable things like electrification of consumer transport and process heat requirements. If 100% renewable in source, then this would have the potential to meet over 50% of the non-forestry emissions reductions required to meet New Zealand's 2050 net zero carbon target. Give me a sec. So some of the specific drivers for transition include policies and legislation that recognise the growing physical, business and financial risks associated with climate change. The current and prior governments have made global commitments in relation to the reduction of New Zealand's emissions profile, and they're obviously now starting to support those changes through required domestic legislation change. Proposed business disclosure requirements in particular will drive an increasing awareness and understanding and transition activity across both private and public sector entities. What disclosure frameworks are really designed to do are provide investors and regulators access to reliable and globally consistent sets of information to support the assessment of the quantum of financial risk being carried by a company as a result of climate risk. And for those of you that have been part of understanding more about the relationship between climate and financial risk, you'll know that people like the likes of Mark Carney clearly articulated from about 2015 onwards that climate risk is financial risk, and so hence the discussion today that we're going to start talking about, well, what does that really mean from a sustainable finance perspective? So whilst TCFD disclosure, so Task Force for Climate-Related Financial Disclosure is what that stands for. So whilst the TCFD disclosure regime is currently a voluntary regime, many of the world's largest corporations, banks, including the bank that I work for, Westpac, insurers and fund managers have signed up on a voluntary basis to the development of disclosure consistent with the TCFD recommendations. The framework really covers 4 areas. First of all, being able to disclose an organisation's governance as it relates to climate-related risk. The second one is the actual and understanding and being able to disclose the actual and potential impacts of climate-related risks and opportunities on the organisation's businesses, strategy and financial planning. Third area is the risk management frameworks or processes that you use as an organisation to identify and assess climate-related risks. And lastly, the metrics and targets used to assess and manage climate-related risk and opportunity. So quite comprehensive in terms of framework, and very tricky to implement, I can tell you. So quite a lot of work to do to get that up and running. What I want to do, is now briefly just talk a little bit more about the Sustainable Finance Forum and how that fits into all of this. So in January 2019, a group of leaders, including participants from banks, the insurance sector, investment funds, corporates, civil society, academia and government were brought together. Truly a public-private partnership. And we were brought together to identify opportunities and make recommendations on how New Zealand's financial system could be aligned with our 21st century sustainability challenges. Specifically, we were being asked to investigate how the current system factors in the use of our environmental and social resources and make recommendations on how the system could be realigned to ensure these factors are better integrated into decision making and capital allocation, ultimately with a view to drive better outcomes for New Zealand's future. In terms of a process, we created a theory of change model to develop a working thesis on the priority focus areas to enable impactful change. And we then went through a process of validating these through, firstly, a desktop review of international literature, including similar work that had already been undertaken in Canada, the UK and the European Union. And also we've been working concurrently with a similar group that has been established in Australia, who will release their report, final report, or their first and only report a couple of weeks after us. So in the latter part of November. We, at the same time, created a number of technical working groups, and they were formed from both participants and users of our financial system. And their role was to undertake a deeper investigation on the New Zealand context and included multiple stakeholder interviews on the focus areas we had identified through our theory of change model. In July 2019, we publicly delivered the interim report outlining the case for change and draft recommendations for further consultation. So since the release of that report, we've gone through further rounds of investigation, held a number of forums, including in the second round multiple forums with government agencies and also with iwi leaders as well as the broader set of stakeholders that I'd mentioned earlier. Now, on the 3rd of November, we will release the final report with proposed recommendations and implementation waves between now and 2030. I just want to talk briefly about what do we mean by a sustainable financial system. So what kind of features could we expect within a system of that nature? And so the first one is we think of it as being a system that intentionally plays a role in supporting the transition to a low emissions, resource efficient, just and inclusive economy. It should be a system where long-term well-being is incorporated into decision-making in an informed and transparent manner. One that has society's trust and confidence, with participants who understand that the system's purpose and their role and responsibilities within it. And it needs to be a system that is able to demonstrate greater resilience and agility through the incorporation of social and environmental risks and opportunities alongside economic, and importantly then aligns capital accordingly. So I'll just talk a little bit about where we are today. So we know that circa 190 billion of New Zealand's investment funds under management today are managed under responsible investment principles, primarily through an ESG decision. And when we talk about ESG, we're talking about incorporating decisioning that picks up environmental aspects, social aspects, and good governance aspects. So you will have an ESG decision framework supporting the decisioning and or negative screening for things like munitions and tobacco. We also know that less than 1 billion or less than 0.5% of the 190 billion under management meets positive impact criteria. So what we could describe then is that responsible investment in New Zealand today could be described as largely one which is seeking to avoid harm. So no tobacco, no munitions, no whaling, etc., rather than investment which is being intentionally weighted towards the creation of sustainable benefit. And that's quite a difference. So taking a negative screening avoidance approach versus actually saying, look, we've got the opportunity to use this capital to direct it towards quite significant change. When we think about the debt capital markets, sustainable and green bond issuance targeted to the development of sustainable assets, so directing more towards that positive benefit process, has really gained some traction over the past 24 months, so that's quite pleasing. But we're still only talking about 6 corporate issuers and 1 bank, the 1 bank being Westpac, completing circa 5.5 billion of issuance in either the domestic market or global markets. That is a very small proportion of total New Zealand bond issuance in either domestic or global markets. And one of the other things I would call out is that qualifying assets to date have really been dominated by property. So Green Star rated property, primarily, with renewable energy assets comprising only 5% of the issuance to date. Globally, through 2020, we've seen an increasing focus as well start to appear on social outcomes as well as environmental, with specific issuance now starting to be undertaken to support the post-COVID socio-economic responses to the pandemic. And a good example of that would be the Bank of America, who in the past couple of weeks have announced a $2 billion 5-year social bond, with the proceeds of that bond to be used for eligible social assets that seek to help to reduce inequalities for Black or Hispanic communities in the United States. They've also chosen to include in that as well the ability to utilise some of those funds for eligible green assets that promote a transition to a low carbon economy. So I suspect not very favourable with President Trump. Sustainable, one second. But as bank lending, so it's still really to get full traction, however, here in New Zealand. So bank lending is absolutely the largest source of debt capital in New Zealand. So talked about 5.5 billion of green issuance there. We've got 400 billion of capital lent by the major banks in New Zealand today. Transparent, sustainable lending, however, when we look at that category, only 1.6 billion is disclosed publicly today, and again, that is Westpac, that publicly discloses, audits and discloses lending that it provides specifically for climate solutions. We know that the 5 large banks in New Zealand all incorporate ESG frameworks in their assessment of risk. But as I said, no, there is only one bank that is transparently reporting or setting, actually publicly setting targets and then transparently reporting against them. Of the 7.2 billion, when I combine the green bonds and the disclosed bank lending, of the 7.2 billion disclosed and audited issuance or direct lending with social and green outcomes, Westpac's providing a third of the total issuance for that. Again, when I look at the eligible assets that we apply under that funding, most to date, again, has gone to green property and renewable energy assets. So that also goes towards the need to create the demand, increase the demand for funding. Not just, this isn't just all about how do we create better conditions for supply. So when I look at, what I'll talk a little bit about now is a bit more about the recommendations that will be coming through in the final report from the Sustainable Finance Forum. So three key themes have evolved in terms of our work to drive the alignment of the financial system with the delivery of New Zealand's sustainable goals. The first one is the need for a change in mindset. And when we're talking about that, we're talking about embedding within public and private sector organisations the imperative for aligning investment, lending and risk allocation decisions with long-term societal goals. So our recommendation focus is going to drive into probably 3 key areas that we believe are absolutely essential if we want to get that shift in mindset and then a subsequent shift in activity and behaviour. First is responsibility. So explicitly requiring financial system actors to consider, manage and account for environmental and social risks and real world impacts. So there you will look at things like fiduciary duties. Who do they extend to and what do they encompass? The second area is capability. So how do we increase awareness and understanding of sustainability, sustainable outcomes and sustainable finance through education and training? So there'll be a number of recommendations coming through in that area. Governance is the third area, and it's how do you incorporate into long-term thinking positive social and environmental purpose and outcomes into governance and stewardship codes. So quite a big focus on there to help reinforce that shift in mindset. We then move to, well, how do you align the financial system? So really what we're talking about here is the greening of finance. So it's a focus on adapting financial models and providing the tools and capabilities to incorporate sustainable outcomes into financial decisions. So things like data. How do you improve data quality and accessibility so that people are actually able to understand the risks that and opportunities that they have within their businesses and be able to assess impact. Disclosure. Should this be mandatory rather than voluntary? And how do you capture private as well as public listed entities? Because there is a risk, and we are seeing it globally, that the easiest way to do this is to make it mandatory or regulated or publicly listed companies because you've got a mechanism to regulate them. But that leaves a significant gap with private sector with privately owned companies, and so there is a risk that you create market distortion. So we talk in the report about some ways to think about that. We also talk about accounting and valuing social and environmental factors. So thinking about the externalities, how do you integrate them and financially account for the cost of social and environmental capital? And in the last area under that is really government leadership. So today I would argue that we've largely seen a private sector led approach to the changes that we're talking about, with government coming in behind. We think there's a need for government to establish an all of government sustainable finance strategy to simplify and align policy and legislative processes to support public sector accountability for action as well. So what are they doing themselves, and then how do they align the policy and legislative process to support the actions that we're talking about? And then lastly, the last area is all about mobilisation of capital, so financing green. So what are the key things that we need to focus on there to help enable that? Well, firstly, we are looking at standards as being one of the key things that need to be created, so that we have consistency in terms of approach and a clear understanding within the private sector of what they need to do in order to be able to meet some of the requirements that we believe are required in order to shift to a more sustainable outcome for New Zealand. So they're kind of the areas that will be picked up in the report, and the whole purpose of doing that is to create that shift in mainstream financial system, and start to make the capital available that is required to make the transition that our economy needs to make. Lastly, I'll just briefly talk to the demand side, and so how do you actually start to utilise sustainable finance? So it's all about the need to consider the opportunity, and how do you think about the application of capital towards that. So if we want to think about the transition of our energy system, it's going to require capital, a lot of capital that will support the development of, if we want to move to 100% renewable, then that's the development of new grid scale renewable power stations and battery storage. I think Transpower assessed something like 15 new grid scale stations would be required in order for New Zealand to get to that. It's funding for the available to create or to support the development and scaling of new distributed energy generation models. We're already seeing fledgling versions of that start to appear in the New Zealand market, and services being offered to consumers as a consequence of that, things like entities like Solar City and the work they're doing to enable solar power in homes as a service, rather than the need to own the underlying technology as a consumer. Scaled electric vehicle fleets, we're talking up to 1.5 million EVs required for New Zealand by 2035. So again, significant capital required for that. All of that needs upgraded grid infrastructure to support increases in both distributed and wholesale generation. So more capital required there. And then of course you've got things like the development of alternative fuel sources, storage to support commercial transport requirements, and potentially some of the demands of process heat as well. So and many of those changes will be driven also through emergent technologies and business models. ascribing, ascribing from a relative comparison from an economic perspective to the status quo means we need to be able to compare apples with apples when we're talking about that as well. And valuing and accounting for externalities like environmental impact, when you are thinking about an emergent technology, the commercial case for that versus the status quo, the understanding of impact as it stands today from the status quo perspective, counting and valuing that negative impact needs to become part of that equation as well. So that's how it all starts to come together, and that's how you start to think about how does sustainable finance start to play a role, a real role, in the provision of the large quantums of capital we're going to need as a country to transition our economy into a much more sustainable economy in the future. So I was going to leave it there and just open up for questions, if there are any questions in relation to any of that material or anything else you would like to chat about.
Okay, I think that's our cue for questions. So if anyone has any questions, you can put up the little raised hand emoji or just unmute yourself and ask the question, or you can type it in and I'll read it out on your behalf. Is that Greg Sykes? Greg?
Yeah. So can you hear me?
Yes.
Yeah. So you might have mentioned this, I might have missed it, but does the government have any green investment funds?
So one of the things roles I actually did a couple of years ago was help set up the framework for the Green Investment Fund. So yes, we do have one. It's small in size, so roughly 100 million only of capital set aside for that, but it also a very specific role. So the role of the Green Investment Fund is to fill that gap where you have a set of a technology or a business model or something of that nature that is proven, but it hasn't reached that commercial stage, and so there may be some kind of market dislocation in terms of being able to access capital to allow you to get into full commercial, that full commercial stage. So the role of that fund is to help fill that gap and then leverage the capital that they're providing to then bring private sector, so bring the banks, bring the fund managers in, taking a slightly different risk position to then help scale those businesses out. So it's got a very specific niche role sitting there, but it is absolutely directed towards green investment in all forms. And they've already made 2 investments. I caught up with them about a week ago. They've made 2 investments, but they've got a very large pipeline of opportunity that they're currently reviewing as well. So I think it's just a case, case of watch the space with how that fund goes.
Okay, thanks.
Thank you, Greg. So would that operate more almost like a VC fund? Is that the idea of that?
Well, yeah, a little bit beyond VC, yeah.
Cool. Is that you with a question, Ivan?
Yes, so Karen, hi again. So one thing we've been doing quite a lot of work here at CEFGroup is looking at climate risk in banks.
Yeah.
And so I'm sort of curious, so if we look at New Zealand banks' balance sheets,
yeah,
they're dominated by real estate lending. And I wondered to what degree you guys are looking at climate risk, in particular physical risk.
So we've had a adaptation risk is obviously a very big risk, right? And we have had a project going here for about the last 18 months, working in conjunction with NIWA, and to access to the right kind of information to understand the risk we might have in our portfolio as a consequence of rising sea levels. There is, as we were talking about prior to the session opening up, there is a paucity of data in New Zealand of the right kind of quality and accessibility for you to be able to really measure that risk in a meaningful way. We have the NIWA data is really just coastal data, and so we have done quite a bit of assessment on that risk and against our portfolio, and we'll be talking about some of that in our TCFD disclosure in the next couple of weeks. So we'll be bringing out some information around that. So that's the start of really using TCFD reporting from our perspective. What that doesn't do though is give you the kind of information you really need when you think about some of the risks we'll see well ahead of that, which are the real, storms, droughts, that kind of, inundation. It's that kind of data that you really need to start seeing. I think the insurance sector is a little bit ahead of that, but again, for them, there's still a lot of work to do in that space as well. So I suspect, well, I strongly suspect that the Reserve Bank will become much more focused on this as well. They've joined the Network for Greening group globally, and obviously the Bank of England is the absolute leader in that space, where they have established various scenarios for the UK and have now got banks stress testing their portfolios utilising those scenarios. We don't have that here, so we're effectively developing our own in order to try and understand some of that risk, but I could see the Reserve Bank starting to bring that in a fairly short order as well.
So in terms of physical transition risk,
yeah,
and also liability risk, is the risk that nobody wants to talk about. So I mean, in terms of those three, and in terms of your balance sheet, which ones would keep you up at night?
Lordy. I personally think that transition risk can be managed.
Mm-hmm.
So when I think about industry sectors, and I'm quite encouraged by the engagement that we're getting from industry to make that change and start to mitigate some of that risk. So that's probably less for me. I think adaptation risk is not being, as we've talked about, is not the information availability and is just not there yet. And that's something New Zealand definitely needs to focus on in order for us to really get that. So that does worry me from that perspective. And, when I think about liability, that is a question that we're all posing ourselves. And yes, like any risk, that's something that is definitely a consideration as well, because you want to help people make decisions in an informed way. And the risk is you can end up with liability as a consequence of everybody keeping their heads in the sand, and that includes local government as well as central government, as well as consumer. But you can also end up with creating issues if you start to utilise data that is not of good quality and create the perception of risk when it may not be as bad as it is. So, I keep coming back to data just being and standards being absolutely critical in terms of building understanding here. And the other area around that is collaboration. No one part of the economy of this on their own. This is going to require in my view, that the risk is so complex, it's going to require government, central government, civil society, the financial services sector, insurance sector, everybody working together to actually work our way through what the complexity is and how do we take it forward from here.
Cool. Thank you very much. I look forward to this conversation at a later date.
Yeah, it's hard. It's very hard.
We have a question written from Michael Jack. So renewable energy and energy efficiency are almost always capital intensive upfront. So I believe this sustainable finance is extremely important. These initiatives mean that finance may be more easily available to fund these investments. I guess I would attach to that as well. Would they charge a lower rate like we see with some green bond issues? How do you see this playing out? Is the Solar City model an example of this?
So I'll talk a little bit about the Solar City one. There's only so much I can say, obviously, so Solar City was a good example where we've used fairly mature financing techniques for a different purpose. So securitization, for those of you that understand financing, securitization of a receivables pool to provide capital over a broad set of consumer receivables. It's just that the purpose is to enable something that we wouldn't have historically looked at before. That took 2 years of working with a small company, one of the accountancy firms doing some work for them, and ourselves to build the right level of understanding and model around how a pool of receivables which is targeted towards something like that might perform in order to be able to determine what kind of levels of debt and equity would be required there. And then it was a little bit of a leap of faith, actually, to just, set it up, test it, go from there. It's been successful. So you start to learn from some of those things, which starts to make capital for new business models or new technologies easier to use, because you've started got some build criteria and knowledge that can help do that. That's where places like the Green Investment Fund come into play, because that's the kind of area where that 2 years of us guys working on the side of the desk trying to work something up there as they're also doing their day jobs. That's where you can have a fund like that has that time and energy and effort, and actually the mandate just to invest that amount of time in terms of doing that. So I think we're going to see more and more of that kind of thing emerge. And I think it can come from multiple providers as well. So we'll see, I think we'll see a proliferation of different kinds of fund models start to develop as a consequence of some of this. From a pricing perspective, sustainable linked loans is a structure that we've already utilised here, which is a structure which recognises that the outcomes or the purpose of the loan has multiple outcomes, not or the organisation has multiple outcomes, not just economic, but also they'll have some very clearly defined and measurable sustainability targets. Could be environmental, could be social outcomes that they are seeking to deliver. You'll have an annual review. If the company has achieved those targets, it'll be third-party audited. If they've achieved them, they may end up with a reduction in interest margin. If they've failed to achieve them, they may have an increase in interest margin. And so we have already established facilities of that nature as well. So starting to think about outcomes that move beyond the normal profitability measures that we would have traditionally used is starting to come into play. There are sectors that I see as absolute no-brainers where you can start to employ that kind of approach, where we're trying to think about a shift in behaviour, and agriculture is one. So on-farm environmental standards, there's a project on the go at the moment with banks working with MPI and a number of other providers, parties in the agriculture sector to think about environmental standard. What's an appropriate environmental standard that banks could incorporate into credit assessment for farms, and the utilisation of that would shift the way you assess that business performance, and you can adjust margin up and down as a consequence of some of that. So I can see a real change coming quite quickly in some of these things. Some of the key things are, again, data, disclosure, and the appropriate standards. Get those tools in place, and we're going to be able to do this.
Thank you. I think that helps answer Robert's question around whether higher than average risk might be accepted for investments that have direct environmental benefit, and you just talked about those do factor into that decision making more and more now. So I just saw that Alan Mark, did you have a question for Karen? Is that right? Oh, you just need to unmute your microphone first. It's the button down the bottom left there.
Yeah, I'm a plant ecologist, environmentalist, and very impressed with the role of the forum. I just wonder who initiated the forum and what's its membership?
So it was initiated by the Aotearoa Circle, which was established by Sir Rob Fenwick, Governor General, is a member, is on the board of that now, and MFE drove that as well. So they've got a number of work streams going on looking at biodiversity. They've got 4 or 5 different areas that they're working closely on. But the Sustainable Finance Forum was the first initiative that came out of it, and so the 3 founding members of the circle approached myself and Matt to see whether we would be interested in driving it forward. They'd kind of set a goal, so we then turned around and redesigned the vision and went from there.
And its membership?
So membership of the circle is, of the membership of the, so we have a leadership group. So within the leadership group we have there's banks, insurers, corporates, directors, representatives from iwi. We've got market regulators involved in that as well, and then we have a range of technical working groups that sit beneath that, and they are picking up people from academia, people from all of the groups that we've talked about above, and not-for-profits as well. And so that kind of forms the large group. There's been roughly 200 different people involved in this.
Thank you.
Thank you, Professor Mark. And there's one more question so far. We might get some more if we have time. By Dugald McTavish. I hope I pronounced that somewhat right. Does the Sustainable Finance Forum's analysis consider at all the potential impact of the underlying and accelerating decline in net energy, or the diminishing return of energy to energy, on finance and our capability to transition? Now that sounds kind of technical. If you need more elaboration, you could chime in.
I can probably answer that by saying no already. It wasn't designed to explicitly go into industry sectors in detail. It's more about thinking around the role of finance and how does finance operate across an economy and the various actors within it, and what causes constraint or reinforces the delivery of certain outcomes. So if we wanted to shift outcomes at a broader on a broader scale, then what would be the levers that you would pull? As you go into implementation of some of the recommendations that we're making, I could see those kind of questions, or as people drive down into industry in more detail, I could see those kind of questions coming up and being critical in terms of evaluation through implementation. As I say, we're talking about waves of implementation over a 10-year period. Some of the things we're talking about are relatively complex to implement, and my experience of policy and legislation changes, it's not fast. So, and some of the key enablers as well. So, yeah, I think it will take some time.
Thank you, Karen. It's Robert here from Callaghan Innovation. Yeah, just a supplementary question. How useful do you think a price of CO2 is as a comparator for balancing the dividend across the whole space?
I think pricing signals are going to be one of the most fundamental things that are required. So mechanisms like the ETS getting the carbon pricing right, it's not at a level today that is going to create the shift that we need and the change in behaviour. Using some of those frameworks and tools and setting them at the right levels is absolutely one of the key tools to get this right. Valuing externalities properly and starting to treat them not as externalities but integral to how you value outcomes is absolutely fundamental, and those pricing signals need to be set at the right levels.
Yeah, I just say I know a couple of progressive companies who've set a virtual price of carbon internally, and so they charge themselves, and from that fund they pay for some of their mitigation.
Yeah.
So they're behaving as if there was a real price.
Yeah, yeah, and so that's where you've got private sector leadership, but to obviously driving forward, and we don't want to cramp that in terms of the recommendations, because we need that kind of innovation and behavioural leadership to continue to forge ahead. What you want in terms of the more legislative frameworks and policies being put in place that's designed to bring the laggards on board and really reinforce it, but create some consistency in standards so that investors are then able to know they're measuring like for like, and that's really fundamental when you want to shift large quantums of capital.
Does anyone else have a question? Otherwise, I might ask one. Okay, so I have a bit of a general question, I guess. With the report, once that's released, I'm curious as to how big of an impact you think that will have, or how, I guess, beholden to that different stakeholders might feel. Or
so we one of the things we've recognised is that you can go do a lot of work on these reports and then they can just go into the vacuum. And so we've been quite actively engaged, as I say, with government on this to get government support and buy-in, and certainly also with key ministers, because we all know that agencies end up doing what the ministers want of them. So we've been actively targeting ministers around that, and it's fair to say we've got pretty good support in relation to this, and we have had all the way quite frankly. But you still need, we believe, a group, and we have a recommendation going in to this to create a centre or institute who is tasked with overseeing implementation. And it's not about necessarily doing the do, but it is about ensuring that tracking, because within the report we will have recommendations around accountable parties for implementation of some of the, or taking the lead on implementation for some of the recommendations. So some of that is about how do you, and some of it will require a lot of collaboration across public and private sector. So how do you facilitate that, and how do you help influence the continuation of that and report against what we've set as the roadmap as well. So that's one of the core recommendations we've been discussing with both the Circle and with government, to make sure that doesn't happen.
Thank you for that.
So I have one more follow-up question, Sebastian, if that's okay. I was just, I've been thinking about, I guess, post-COVID and post-COVID recovery and where the government funds are going to be targeted. And I guess it's kind of a little bit worrying from an environmental perspective if the funds are not specifically targeted to environmental areas. So, I mean, does that mean, I guess, that for any environmental purposes, we're reliant on private capital more? I didn't really know how to ask that question.
Yeah. Look. I fully understand what you're saying. I always get worried when they use the term shovel ready, because it gives all the wrong connotations. The only thing I can say really around that is that we as both Circle, Forum, I certainly know SBC and CELS and the Climate Leaders Coalition as well, and various other bodies representing also large, a significant portion of the larger business community in New Zealand, have been putting through to the government the need to focus on, this is your opportunity to reset this economy. It is not, and it's an opportunity that shouldn't be wasted. And so whilst there is absolutely the need for jobs to be spun up quickly, to keep people employed, there's also a need to focus on ensuring that we are, that the money you're talking about investing is going into activity that will help that reset and not cause further damage. And that is, it is a significant risk. There's no doubt about it. But there's also, look, there is quite a loud voice coming out of business, and I would argue broader community, that they don't want to see it done in a way that causes further damage, and in fact it should be done in a way that supports that the reset we're really talking about here for the future.
Okay, thank you.
Whether they hear it, we'll see.
Yeah.
But look, it's also, we're talking about in this that participants within the financial services sector should not be standing back and waiting for the government to tell them what to do and where to support, but actually change a mandate internally to recognise that we should be directing capital towards positive impact outcomes, not sustaining old practice.
Okay, Thank you, Karen. I think there was a lot of useful information that you've shared with us and a few hints at what might be coming out in the report, which is really nice. And just on behalf of the University of Otago, CEFGroup and OERC, I'd like to thank you for your time. And I personally look forward to continuing this conversation up in Auckland in a couple of weeks.
Okay, a pleasure. Hey, thanks for inviting me along.
You're welcome.
Thank you.
Bye, everyone.
Thanks, Karen.